Hello traders, and welcome to this week's market report. I'm AJ Monty, and this is a one-year daily candle chart of the diamonds, which is the ETF for the Dow Jones Industrial Average. As I do each and every week, I leave my lines in place from last week's report, and you can see that last Friday I drew this diagonal line with the end of that line being my target. And Monday and Tuesday it looked as though we were going to miss on that entirely. But by the end of the week, especially Thursday here, we came within pennies of that low. And then we had this bounce. You see, we had a gap up. Early on in the day, it looked as though the bulls were going to run away with it. Then guess what happened? By the close of the day, we have this long shadow, very much like an inverted hammer, gap below the market, wide divergence from that moving average, gaps down here again, drop in volume, which is bearish, stochastics crossing with a sell signal, CCI not pivoting lower, but watch what happens on Monday. As I delete these lines right here, I'll clear the whole drawing set. I'm going to draw my lines for next week and what I think could happen. Watch, I'm going to take this line right here and I'm going to mark that as my speed line. I'm going to duplicate that, or I'm going to duplicate the drawing, and all I'm going to do is move it on over just like that. There's my forecast for you. Same angle, same end of line target, and I think that target right there, for those of you that need that number, 279 by the end of next week. And we'll have to see whether or not this 20-period moving average holds for the diamond. We had, again, a lot of selling pressure on the close. Not any news stories that were driving that. It just, to me, looked like a technical sell with some volatility attached to it. We saw the volatility index start to rally, and that's where I'm going next. The VIX. This is the CBOE Market Volatility Index for the S&P. And I left my lines and I left my cycle brackets on there so you can see. What I said last week is I marked the cycle of the VIX and I showed the difference and the similarities of these troughs here. And if you go back for the whole year, had you bought on any one of these troughs, as we call it, at the bottom of that cycle, you would have made money every single time in the week that followed that low point there. And I forecasted that the VIX would most likely rally. Now I'm going to get rid of these lines and I'm going to show you what I think we could see for next week. This is, as I zoom in here, a very pronounced, what looks to be a hammer pattern. That's a long shadow candle right there. Let me magnify that for you, just like that. And we closed over that 20-period moving average. So what does that mean? Next week, I'm forecasting that the VIX could move up just like that. What am I doing? I'm drawing a speed line that matches the angles of past upward legs, and I'm just forecasting out about 5 or 6 trading days. That's it. End of the line there for the VIX is 30.3. I have that line ending on October 23rd. And the reason I do that is for the option traders who are trading the weekly options. Now, with that said, let's go to the spiders, S&P 500 ETF right there. Very similar to what we saw on the diamonds. We didn't quite come down to my target on that, but all I'm going to do is I'm going to duplicate that line just like that and move it on over. That's all I'm going to do, just like that. And I think that's what the target's going to be for next week, is going to be the end of the line right there is 338.23 to end on October 22nd. One of the other reasons I think the S&P could pull back to this moving average is because we had a wide divergence back here that matched what we saw back here, and I pointed that out last week. What's happening down below? On this red candle with that slight shadow above that candle, see that as I magnify it, that long shadow above tells us there's selling pressure coming in. And when you have the higher volume coming in on that red candle, tells us the sellers are becoming more motivated. We have a cross sell signal on stochastics. The CCI hinged up just a little bit, but I think that will start heading lower next week. And that's my forecast for the S&P. I'm going to hop real quickly to the Qs, which is more or less the ETF that tracks the Nasdaq. The tech sector here, again, heated up in the morning, filled the slight gap, and then we got pounced on. If you were watching on the close, the selling pressure continued right up until the closing bell. Now, last week, I said that the Qs could most likely rally early in the week and then start to pull back. We got that rally, we got the pullback, but we didn't hit the target just yet. Why? Because we ran out of time on that timeline. I'm going to duplicate that line, make it a little bit easier for you to see how I'm drawing my targets. And then all I'm going to do is move that on over with the end of the line being my forecast. And I'm going to announce that for you here shortly. The end of the line is going to be 281.81 to end on October 22nd. Look below. You have the stochastics crossing with a sell signal. You have the CCI hinging lower. Gaps below the market, not quite filled. It will most likely fill Monday or Tuesday next week. And then we'll have to see whether or not this 20-period moving average will hold at that level. That moving average, by the way, is 279.54. If we look at the IWM, which is the Russell 2000, that's the ETF for the Russell, you see that today we had a small body candle. That's also known as a spinning top. It's not quite a perfect spinning top because you need a shadow at the bottom, but these small body candles generally show up at the tops and bottoms of right before pivot points. You can see back here, very similar small body red candle, and we are right at a resistance point. So I'm going to leave that resistance point in place. I'm going to duplicate this line, shift it on over to the right, connect it to the close today, and there you go. I still think we're going to hit our target that I set from last week, and I'm going to leave that in place again at 157.24. Remember, there's still an open gap below the market here, and that gap will ultimately be filled at 153.21. Again, the timeline on that is October 22nd. Look below. You see this cross on the stochastics. You see the hinge here starting to go up, but I think the CCI will go down. Why? Because we have a total negative divergence in that oscillator overall. And that is it for our forecast. If you could, please go and click on the like button and share this with as many friends as you know, and family members especially, who are invested in the market or who trade the market. Our goal is to help people learn how to read these signals and how to better position themselves through good, solid risk management strategy. There's also a notification bell at the very top right of the page. If you click on that, the YouTube channel will notify you when we post our latest video. Again, like, share, subscribe, and hit that bell. And we'll see you next week. So long.